What's going on, guys, and welcome back to a new video. Now, this one is just a quick video based on entry techniques. There's 3 different entry techniques that you can look at when entering trades. So if you ever find yourself when you trade from a supply demand zone that you set a sell limit and your stops are above or below based on the zone, depending whether it's a supply demand zone, and your stops are just below or above it, and then you get wicked down and it continues in your direction. You got the overall direction of the market right. You've chosen the right zone, but it's just a little tiny wick that stopped you out. Now this will help get rid of that. This is mainly based on market executions. However, I will show you an example based on a limit order as well. So let's jump into it. So say for example, right, before jumping into it, I must say this will work for a demand zone as well. I'm just showing you based on a supply zone example, but it will work on a demand zone. There's nothing changed. You can just go ahead and flip it and it'll work based on that as well. But we're focused on this example, the supply zone, and as you can see, for example, price is trading up to it, price is now tapped into it. So if you set a sell limit, you would have already been stopped out of the trade. You would have ended off the open and the stops above the zone, and it would have took you out of the trade and continued in your direction. Now here's something you can look at. This one is higher probability but not the best risk reward. It does depend on the candles and the time frame that you are on, simply because obviously just the candles and stuff like that, and spreads and whatever, right? So for example, as you can see here, this is entering based on the break of the candle. So as you can see, price is tapped into our supply zone. We've seen this huge bearish engulfing candle to the downside, followed by another bearish engulfing, well, not a bearish engulfing, but a bearish candle, right? But all that you're looking at is a break below the wick low or the wick high if it was a bullish engulfing of the that candle. So as you can see, price tapped into it, formed a bearish engulfing, price is broken below, so you have entered on the break, right? Assuming that it's performed the top wick and it's now breaking below the previous bearish wick low. Okay, so that is an entry technique number 1, and like I said, you can study it, you can back test it. It's completely up to you. It's very simple. There's no need to overcomplicate things. There's other things that you can factor in, like wick rejection. So for example, if you look at this had a wick rejection, had a bearish engulfing, right? That's a higher probability trade setup. And remember, this is a probability game. It's not about being right or wrong. It's about the probability of the trade. Number 2 is entering based on candle closure / next candle open. All that you're looking at here is when price taps into your supply demand zone. In this example, when price formed the bearish engulfing, you will enter straight away based off that closure, right? Assuming, well, for the next open of the candle. You may get a little bit of drawdown on this one. For example, it may wick above, right, before continuing bearish, and it's very simple, but it works. Okay, so you're entering based on the candle closure / next candle open. You can ignore that, it might be some confusion there, but all that you should focus on is the candle closure, and you can enter based off when the candle closes. And if you're looking at when obviously the candle closes, if you're on a 1 minute time frame, well then it's every 1 minute. If you're on a 1 hour time frame, then it's every 1 hour. So if you see, look down here, if say for example this was entering based off a 1 hour time frame and it was 15:59, as soon as as soon as it turns into 16, that is when you enter the trade, right? The second that it turns. And you can do this if you for example, I like to use MetaTrader 5, and you can use the one-click trading. And for example, if it's the 1 minute time frame and the second clicks and the clock ticks to, for example, 0 and it's about to hit the next minute candle, you just click sell in this example straight away on the one-click trading, right? And then obviously adjust your stops and stuff like that. And that's one way to do it. Number 3 is setting a limit order or market execution on the 50% of the candle. So all that you're doing here is, once price forms a bearish engulfing candle, you'll usually see price on the next candle perform a top wick, tapping you into the trade before moving in that direction, right? Obviously they all have different pros and cons, number 1, 2 and 3. They all have their own pros and cons. For example, if we look at 1, right, you can see here that it doesn't offer the best risk to reward ratio, but you're guaranteed to be in a trade if price does break the low, right? And again, another pro to this is that, because that was just a con, but another pro to this one is, if price breaks the low, then it's high probability of it going in that direction, right? Because sometimes if it doesn't break, if you only look for this and it doesn't break the low, well then you're not in the trade. So you're always waiting for that break of the low, right? And that can include, if you look for candle closures, then that's fine, but it doesn't include the candle closures. You're just looking for a break. That's all you're looking at, right? It doesn't matter about the candle closure, as long as the bearish engulfing or the bullish engulfing has formed already, right? Number 2, pros and cons. Obviously, it's slightly better risk to reward ratio, but the only sort of con I can think of this is that it can sometimes not, obviously, it can just form a bearish engulfing before continuing bullish, right? That's the only con I can think of. But like I said, if you chose the right supply demand zone, well, then it's a high probability trade. And number 3, this obviously, you know, offers the best risk to reward ratio in terms of RR. The only con I can think of this is that only sometimes it may not come back to the 50% of that, right? If you're using limit orders, for example, you set a sell limit based on the 50% of this candle, sometimes it may not come up to that, right? So maybe if you prefer to enter based off the open, then that's a better one than choosing this, because like I said, sometimes it may not perform that top wick, right? Another few notes to add to this is, if price is already wicked into the area, that's higher probability. If it hasn't really wicked into the area, we just sort of tap into the open and perform the bearish engulfing, well, then that's slightly less probability. And like I said, it's not about being right or wrong, it's all about probability, okay? So it's completely up to you which one you use, and I'll show you an example now. If we just go to, 5 minutes, fine. I'll show you an example now on EU, and you know, you can go ahead and backtest this. It's just something to look for. You don't need to overcomplicate. It's very, you know, simple, and it's just helping you increase that win rate, right? So as you can see, we had a supply zone here. So if you set a sell limit there, right? I'll just get rid of this magnet for now. If you set a sell limit there and your stops were just above the zone, right, you would have been stopped out the trade, but it continued in your desired direction, right? So that was obviously an unfortunate trade. But what you can do is, if you go down to, let's say, the 1 minute time frame, and I must say, it doesn't matter what time frame you use. If you're using a 5 minute point of interest, then maybe the 1 minute is better, but it all does depend on our momentum as well and how the candles are displaying, right? But like I said, if you chose the right zone, then a lot of the time it will work in your favor. But as you can see, price came back into this area, performed a huge wick to the upside, right, which is essentially just saying I'm rejecting to the upside. Then what happened is price formed a bearish candle. Now I must say, it doesn't matter whether it's a bearish engulfing or bullish engulfing, because an engulfing is where it closes above or below the previous candles. I don't personally look at that. I just look at any sort of bearish or bullish confirmation. You know, I don't really look at the engulfing candles. But obviously the higher probability one probably would be the engulfing candles where it closes below the previous candles, right? And what I mean by that is, for example, as you can see, this is the low of the candle. So what you'd look for is a candle breaking that low, right? And that would be your entry there, and your stops obviously above the wick, whatever, right? But yeah, that's just another entry technique. There's so many different ways you can approach it, but for me, I don't really like entering based off limit orders, just purely based off this reason, right? But you know, sometimes you might have to. But if you're trading a lower time frame, then you shouldn't be using limit orders. If you're trading higher time frame, then yeah, you should maybe use the limit orders. For example, if you're trading from a daily demand or supply zone or an hourly supply demand zone. But this is purely based off just being in the moment and looking at the ranges, right, and looking what structure the market's in. But as you can see, right, price performed a bearish candle. So if you entered based off the closure of that candle, well, then you'd be in the trade, and obviously your stops would be above the wick, right? Next one is obviously break below the lows. So if you entered based off that, you'd enter probably around here when price breaks the low. Obviously a pip below it, whatever, and as you can see, the risk to reward is much different. If you entered based on the 50% of it, well, let's just take a look at where the 50% is. As you can see, it's a much better risk to reward, and there's much minimal drawdown, right? So that is probably the better option in terms of drawdown and stuff like that. But you must remember, not always with a guarantee price, not always with a guarantee it's going to do that, but yeah, that's the 3 different entries there. I think the best thing to go for would be just looking at the engulfing candle or looking at the bearish candle, whatever, and entering based off that closure, because that way you're guaranteeing yourself to be in a trade. And rather than looking at, that's probably in the middle, I would say. But for me, I like to obviously opt in for that 50% retracement back to obviously the 50% of the candle. And if we just look at this example here, say for example we're looking to buy from here, right? So if you entered off a buy limit there, stops below the zone, well, you can see it would have been stopped out of the trade. But if you look at the entry technique that we just spoken about, so price formed a bullish candle, stops below the wick, you'd be in the trade, right? Yeah, a little bit of drawdown, but who cares about a little bit of drawdown? It's a winning trade, right? Stops all the way above the high, whatever, right? And obviously from there it's a winning trade. Now again, if you want to enter off the 50% of it, what you can do is just measure that candle 50%, which would be here, alright, and there you go, much better risk to reward, slightly less drawdown. If you look for a break, bigger risk to reward, I mean less risk to reward, dramatically risk to reward in this case. You know, what went from a 12% is now 5%, but you're in the trade, it's guaranteeing you being in the trade, and obviously there's more drawdown. But I think, yeah, if you want to just trial and error, see which one works for you best, that's completely fine. But for me, I like to use the mixture of just looking at the candle closure and the 50% of it. Okay, but you know, it depends. If you prefer to look at actual engulfing candles where it actually closes below or above the previous candle, then that probably is going to be the high probability ones, alright? But yeah, let me know what you think of this video. If you have any questions, make sure you let me know. It's just a simple entry technique that you can look for. It's very simple, and hopefully I've explained it very well. If, like I said, if you have any questions, then, you know, please let me know. But you know, it's just, if you use these entry techniques, it's just helping you and allowing you to increase your win rate, rather than, you know, setting your sell limits or buy limits off there, or entering based off the market execution, because, you know, stops are below the zone. Is what we're taught to do, is what we'll have to do. And as you can see, you would have been stopped out and it would have moved in your direction, right? But if you just use that extra little bit of, I suppose you could say, that the little entry technique that we've spoken about in this video, well, then it's gonna allow you to be in a trade, right? Because we don't know what the market's going to do. We don't know where the market's going to stop and reverse from. All that we know is obviously to trade from the zones. But like I said, you know, plenty of times in this video, you would have been stopped out, right? So just opt in for that slightly entry technique. Take the trade, stops below the wick, and sometimes, yeah, it may come back down, close below, and that's fine. That's just a loss, right? Don't get worked up on it. Move on to the next trade. But like I said, just when you're back testing, just implement this new technique, and let me know what you think. Let me see some of your results, and yeah, have a great day, guys.